So, hello everyone guys, and I have one question for you. Ever wondered why the market always seems to hit your stop loss right before going exactly where you predict? Let me tell you, this isn't just bad luck. It's called a liquidity grab, and it's one of the most powerful tools in smart money, uses to manipulate the market and the trap retail traders like you. Here's the thing, understanding liquidity grabs can completely transform the way you see the market. Instead of being the one who gets stopped out, you can be the one taking advantage of these moves. Today, I'm going to show you exactly how liquidity grabs works, how to spot them, and how to use them to your advantage. And trust me, there's a game-changing tip at the end of this video what you won't want to miss. So, what exactly is a liquidity grab? And its core is when big players, what we call smart money, manipulate price to trigger stop losses or lure breakout trades into the market. Why do they do this? To create liquidity, which is necessary for them to execute their massive trades without creating too much price slippage. Let me break it down with an example. Imagine we're a swing high on the chart, and many retail traders are placing way stop losses just above it, like that, to open short position. Smart money knows this and intentionally pushes the price just high enough to trigger those stop losses. This creates the liquidity we need to enter the trades, and as soon as the stops are taken out, the price reverses and moves in the opposite direction. Now, why do retail traders keep falling into this trap? It is because we focus too much on obvious levels like swing highs and lows, which are exactly where liquidity pools form. Smart money uses this to their advantage every single time. Here's a quick chart example to help you visualize. Notice this spike above the swing high? That's a textbook liquidity grab. It wiped out stop losses before reversing sharply. And if you don't know how to spot these moves, you'll get caught just like everyone else on this example. For example, a lot of people open the short positions here after the breaking of key level, and smart money traders need liquidity to open positions in the reverse side. They grab the liquidity pool here, and afterwards the price gets reversed. Coming up, I'll show you exactly where to find liquidity zones on the chart and how to predict when a grab is about to happen. Trust me, this is where things get really interesting. Now, when you know what a liquidity grab is, the next step is learning how to identify the zones where these traps are likely to happen. These are called liquidity zones, and they're the key to spotting high probability setups. So, where do liquidity zones form? There are three main areas you need to focus on: swing highs and swing lows. These are obvious areas where the retail traders place their stop losses. Smart money loves targeting these levels because they are full of liquidity. Psychological levels, big round numbers like 1000, 100 or 1200 act as magnets for retail traders. For example, like here on the BTC chart is the meaning of 70,000, 71,000, 72,000. You can see the equal highs here, and of course 78,000 on the next chart, and of course the all-time highs. We feel safe, but we are actually prime targets for liquidity grabs. And of course consolidation zones, which are we market with Fibonacci grid. When the market moves sideways for a while, stop losses and breakout orders stack up on both sides of the range, creating perfect conditions for a liquidity grab. Look at the consolidation zone. See how prices spikes above the range, grabs liquidity, and when reversed. For example, here the liquidity grab, and here the grab of liquidity, and after that the price reverse and go on the bullish movement. With market money at work, they took out stop losses, filled their orders, and then moved the market in their desired direction. The key is to train your eye to spot these areas before the grab happens. Mark swing highs and lows, not psychological levels, and identify consolidation range. These are your maps to where the action will likely unfold. Up next, I'm going to reveal how you can turn these liquidity grabs into profitable trade setups. This is where you stop being the prey and start trading like a predator.
And don't forget to subscribe my Telegram channel, where I write my thoughts on the market, useful information about trading, and post my trades. Have fun watching.
Once you identify the potential liquidity zone, the real magic happens when you wait for the grab and then use it to grab your advantages. Here's how you do it step by step. For example, you need to mark key level points, the liquidity zones on the chart. For example, here, as I showed in the previous few minutes of lesson. Look for those swing highs, swing lows, psychological levels, and consolidation zones we talked about earlier. Wait for the grab. Patience is critical here. Don't jump in the trade when the movement price approaches a liquidity zone. Instead, wait for a sharp spike or move that triggers stop losses or breakout orders. This is the liquidity grab itself. You can see it on this example. For example, here we are waiting for the liquidity grab, and after that we are waiting for retesting our point of interest zone, for example VG or order block, and only after that we are entering for the deal. Once the grab happens, you need confirmation. Once the grab happens, you need confirmation before entering the trade. This could be a strong rejection candle like a pin bar or an engulfing candle, a breakback into the original range after the spike, or even a clear change in the market structure on a lower time frame or the Fiji and order block, as I said before. And step 4, enter the trade. After confirmation, it's time to enter. Your stop loss should go just above or below the liquidity grab zone, and your target should align with the overall market structure and risk reward ratio. Here's a live example. So in this chart we have some examples of liquidity pools what are gonna be grabbed. For example, here a new swing high and a new swing high, and above this we have our entering zone. It's our order block, and we can place a deal like that on the entering at the beginning of order block and stop loss behind it. But to be a lot safer in this deal, we are gonna place it on the this liquidity grab, because if the price grab is high, our idea of the deal are gonna be wrong and we don't need to trade like that. And we place our take profit on the lowest liquidity pool. And deal happened like that. And now the bonus tip for higher accuracy. Want to take it to the next level? Combine liquidity grabs with our smart money concepts like order blocks or FVG. For example, after the grab, price often retraces to the order block before continuing its move. This is an even better entry. Now I'm going to share the most common mistakes traders make when dealing with liquidity grabs and how to avoid them. Now what you know to trade liquidity grabs, let's talk about how. Now when you know how to trade liquidity grabs, let's talk about the common mistakes that traders make when trying to use this concept. Avoiding these pitfalls is just as important as understanding the strategy itself. The first mistake is jumping in too early. One of the biggest mistakes is entering a trade before the liquidity grab is confirmed. Many traders see price moving toward the key levels and assume the grab will happen, but sometimes it doesn't. The result, you get caught in a fake move and take unnecessary losses. For in this example, the price gets the liquidity, but it's repeated. It was two-step liquidity grab, and you can easily get on this trap. How to avoid it? Always wait for clear confirmation, like a rejection candle, a change in the market structure, or a break back into the range. Be patient. It's better to miss a trade than to jump into a bad one. For example, in this situation, you can wait for the retesting of our order block here, and after the impulsive movement is confirmed, and you can easily enter from it and get a huge profit. The next mistake is ignoring market context. Another common mistake is focusing solely on liquidity grabs without considering the overall market context. For example, if the market is trending strongly, a liquidity grab must only be a minor retracement before the trend continues. You need to align your trades with a bigger picture. For example, here we have an uptrend movement, and after the price grabs the liquidity on the swing close, it's gonna continue the uptrend movement because you don't get a confirmation of the beginning of downtrend movement. And here you need to trade in a market direction. Don't trade against the market. And the mistake number 3 is a poor risk management. Even with a perfect setup, poor risk management can ruin your trade. Traders often place stop loss too tight or risk too much on a single trade, hoping for a big win. Liquidity grabs are unpredictable, and even the best setups can fail. Use proper risk management rules, risk only 1 or 2% of your account per trade, and give your stop loss enough room to account for the market noise. Remember, it's about consistency, not hitting home runs. And to be a master in the risk management, you need to use this tool. It's a common trading view tool. Here on if you click double time on it, you can enter your account size and your risk, and it will help you to calculate your amount of active what you want to trade and how to avoid big losses. Alright, now let's take everything we've learned about liquidity grabs and turn into full trading strategy. By combining this concept with our tools, we have power system that you can give you an edge in the market. Number 1 is a multi-time frame analysis. As I told you in every video for the trading on the market, you need to analyze all time frames from the 1 day to the 15 minutes to identify your trend, to identify your key level points, key levels of liquidity, and how to enter from them. Don't trade against trade, don't trade against trend. For example, if you spot liquidity grab on the daily chart, look for the confirmation on the 50-minute time frame chart to fine-tune your entry. This helps you avoid false setups and increase your accuracy. Combine with order blocks and imbalances. For the entering into trade, you need to wait for the retesting of point of interest zones, for example FVG or order blocks. It's a better ways to enter your deal. And step number follow to enter good trades, journaling and backtesting. Finally, always backtest your strategy and keep a trading journal. Record every trade, note what worked and what didn't, and refine your approach over time. Trading is a skill, and more you'll practice, the better you'll get. So drop your likes, guys, for this wonderful video. Follow my Telegram channel where I'm gonna drop all the materials from this video. And don't forget to comment about your liquidity experience. And goodbye, see you in the next day.